Welcome to TheoTrade. This is Don Kaufman. It is August 17th, 2016. I start this evening by taking a look at the S&P futures, which once again, shocker, massively unchanged. Here we are with about 4 minutes left to go in the trading session, and you are looking at the S&P futures up a whopping 250. The vol futures down pretty good. Bonds fairly stable, given the fact that today we had the FOMC minutes come out. If you missed it, don't worry, you didn't miss much of anything. Unusual to see both bonds up, notes up, and financials up, with the S&Ps though just really drifting right now. And specific to the S&Ps, and I've been looking at this a lot lately, is the volume. We're actually doing almost 1.6 million contracts today, which is much heavier than we've seen as of late. Now, I brought up a chart here, which is, first of all, unlikely for me. I grew up as a kind of a quant in the markets. I guess you could call me an anti-chartite, even though we recently brought on a known market technician, which is Jeff Bierman. He's going to be a little bit of a chart specialist. But in the last few days, something has kind of come to my attention, and I've looked at this a number of times in our chat room, and I'm just going to bring everybody in and kind of up to speed over here. What you happen to be looking at right now are the S&P futures. Now, whether you trade futures here, it's not the argument whatsoever. The S&P futures, though, they drive a tremendous amount of order flow to the marketplace. This chart is a 30-day, 30 full day, 1 hour at a time chart. So what it ultimately does is compiles the time frame each hour. So each candle in here represents an hour. So over the last 30 days. Now, I'll just start right back here. And if you do look at the dates specific over here, starts kind of, early to mid-July. We have been trapped inside of this incredibly tight range in the S&Ps. Now, it doesn't necessarily do it justice just to draw a box around it. But if you're looking at this right now, you're like, that's wonderful. It's been some of the most boring trade that I can remember in recent years. And that's the way that I view it. Now, there are plenty of opportunities out there. The NASDAQ, for one, has not been trapped in this incredibly tight range. The NASDAQ has actually been exploding to the upside, while the S&Ps have maintained a relatively flat and kind of orderly market. Volatility is extremely low. But something has kind of occurred to me in the recent days. So we're seeing, again, day after day after day after day of, for the most part, nothingness here in terms of a range. The issue that we're going to be facing is that the longer we stay in a tight range, and we're breaking all kinds of records right now with how tight the range really is here in the S&Ps. I mean, to put it again into perspective, we've been inside, for the most part, a 10 to 20 point S&P futures range. Now you have to, again, put into perspective, this is a $2,178 product that cannot get out of its own way. All right, so what's the issue? The longer we stay in this definitive range, the more risk that gets thrown on. So what's going on right now that you really have to start to concern yourself with is you better know the risk of your portfolio right now. Because over the last month, more and more risk is being put on. And whether you're a professional trading firm, whether an institutional money manager, whether you're, Joe Schmo sitting at home trading a few options, or a future scalper of experience, you're layering risk upon the same area again and again and again. And the way to, I think, really kind of elaborate this, and the market's about to close here, and where's the market going to close? For the most part, unchanged once again. Again, we can't get out of our own way, right? So the way to kind of elaborate upon this is think of trading firms putting on risk, for example, here. What kind of risk? Well, some of the firms are buying options, some of the firms are selling options, right? So, all right, they're putting on risk here. A few days later, they're putting on risk here. A few days later, they're putting on risk here. What have they actually done? Well, they've stacked risk, okay, in the exact same area over 3 different time periods, and they continue to do the exact same thing. Now, the more that this is going on, the more it's actually trapping us in this given range. Why? When the market goes up, these firms are forced to hedge the positions. Okay? No matter what the position is, they're forced to hedge or defend their positions. When the market sells off, these same firms are forced to defend the position. The issue that we're getting, we're spiraling more and more risk right into the same deviation. By the time you start out, all right, risk is nominal. By the time you look at 30 days later, there could be hundreds of billions of dollars at risk now in an extremely or extraordinarily tight range. What does it mean for you? It means when we break the range, you better watch out. You could get your head lopped off in a range that has been this tight. Again, statistically speaking, we have never been in this tight of a range for this period of time. Now, one of the last times we were in this complacent of a marketplace would have to be back in 2007. The issue you're going to get when we finally do break this range, could we break to the upside? Absolutely. Now, don't let my directional bias persuade you. Do I have bearish positions on? Absolutely. I do. I am short, currently short over 6,000 spider deltas. All right? For the most part, that means whatever my position is, I'm equivalent to being short about 6,000 shares of the spiders. Don't let my bias persuade you. We could explode to the upside, followed by, a tremendous fall. Again, I believe right now, more than ever, the risk reward, it pays to be short. Okay? But the tighter this range becomes, and it is extremely tight, the more nervous I'm becoming about it. Because again, every day we sit here, more capital is getting stacked, more risk is being thrown into the exact same standard deviation. This is what traders do on a day-to-day basis. It's not about just the markets moving up or the markets moving down. We talked about last weekend getting long volatility. It's about how much risk may be at one place at one time. Okay? And you can say by looking at this, undoubtedly there's a tremendous amount of risk, okay, in and around the current strikes here in the S&Ps. Option trades, futures trades, they're all progressing in the exact same standard deviation over the past 30 days here. Now, what we're going to be looking for in the next couple of days, few weeks, when we break the range, it's likely going to be a catalyst. What kind of a catalyst? It could be anything. Okay, something as simple, for example, is, well, today we had news out from Target. Target didn't seem to impact the markets all that much. Target's down about, 6.5% over here. Tomorrow morning, you're going to get earnings from Walmart. Again, retailers, they matter. Now, this is the tail end of earnings announcements, and it's not as likely that earnings is going to be the catalyst. It could be news, all right, out of, for instance, the Chinese economy. It could be news out of the Japanese economy. Or, for example, we saw GDP here in the U.S. Really, the estimates didn't even do it justice of how poor the GDP was. That did not rock us. Okay? A week ago, bad news didn't rock us out of this incredibly tight range. Look for catalysts. Be 100% comfortable with your risk right now. You're going to need to be, whether you're long, whether you're short. We are just wound up and coiled at this point with hundreds of billions of dollars at risk. Think about it. Make sure you know what your risk is. Thanks everybody for joining us here at TheoTrade. Back all this week in the TheoTrade chat room. Have a great evening. Bye-bye.